There's one other part that sellers I probably need to know about, and this might be one of the hardest parts of the deal life cycle for a seller. Why are they such a pain?
When you're making that final representation, everything needs to be right because it is a legally binding agreement that says this is the status of things as of this particular point in time that you are then signing your name for.
Hi, I'm David Katch, Chief Collaboration Officer.
And I'm Shaun, CFO and Head of Mergers and Acquisitions. We lead deals at Redwood Services, one of the most prolific investors in the home services industry, where we've raised and closed over 60 deals and $2 billion in total transactions.
We're the guys who get excited about doing deals where everyone wins.
It's not only that we're passionate about it, but we enjoy sharing with the people who benefit from it most, home service business owners.
These are our insights, real, honest, and authentic.
Welcome to Sell Yeah.
Let's get into it. All right, today we're going to talk about deal life cycle, the different steps in a deal from beginning kind of to end, what sellers should expect in those different pieces of the life cycle, how we look at those different pieces. So I think it should be a kind of a fun one we're going to talk about. We've done so many deals and every deal is different, but I think the framework of the life cycle of a deal, the different steps of a deal is pretty straightforward.
We're hoping to tell y'all what to expect over the course of a deal process.
Okay, so let's start. What is kind of the first step in a deal?
Sure. So the first step is the getting to know you process. I like to think of this as pre-LOI. So you are in the courting phase. You're getting to know a buyer or a seller very early on. You are doing initial diligence, very high-level summary items. You definitely want to get an NDA executed ahead of time. It's a non-disclosure agreement, which means that each side cannot disclose any of the information that they're learning about the other side. And then you're really just trying to make sure that you're going to be comfortable in getting to a framework of a deal, potentially.
What level of diligence is kind of done at that stage, and what are we looking at?
It's kind of dependent on the buyer, obviously, but generally speaking, this should be a much more summary level of diligence. Maybe you have summary monthly financials. Maybe you have operational reports or KPIs or trends that kind of tell about the story of the business. Maybe you have an intro call or two to discuss sort of the findings and or learnings or what's going on in the business on a day-to-day basis. But this is really kind of the early on preliminary stages that will ideally kind of help identify the framework of a deal.
And I think this stage also is, I think you mentioned it, but this stage also is kind of where the relationship starts. The relationship building, which we've seen many, many times, is critical to deal making. Having trust, we've talked about in the past, having trust with both sides, and making sure that the sellers certainly feel comfortable with, who they're potentially selling their business to. Okay, so now we're in the pre-LOI stage. We've done a little bit of diligence. We've looked at some financials. We've hopefully built relationships and trust between the two parties. We've signed a non-disclosure agreement. Everything's going to stay confidential. That moves us now to the LOI stage. What do we expect at that stage?
At the LOI stage, what you're doing is you're agreeing to a very high-level framework of a deal. So it's things like the purchase price or the consideration, if there's rolled equity or not, the high-level key terms, and just the general understanding of what the deal process is going to look like in the future, in addition to signing for an exclusivity time period.
And we also had a brilliant episode that we talked specifically about the LOI and the LOI process. So if you want to learn a little bit more about that, you can go watch that one. But
super enthralling, episode 1.
Exactly. Okay, so now we've presented an LOI. An LOI is signed. A letter of intent is signed. What's the next part of the deal stage?
This is really where you kind of get into it. Once you sign an LOI, it becomes a full sprint. Usually for somewhere between 75 and 90 days. It can be shorter depending on the buyer and frankly the seller's preparedness for the deal process. But getting to a close is going to require a lot of hard work from a lot of different folks and advisors. And it'll ultimately be a second job for the seller, which is something I like to tell people on the front end so they know what to expect.
Yeah, it can get rough. I mean, it's not a simple process.
Not at all. So let's kind of talk about sort of some of the work streams that you have to go through. So number one, there's operational or commercial diligence, which is how is the business operating today? What areas of opportunity are there for both the seller and the buyer together? And what areas for investment could there be potentially for the future of the business? That's really where at least the buyer is going to want to spend a lot of time to make sure they understand what's going on the ground.
And it's not just specifically with operational diligence, it's not just to learn about the business and whether or not it's the right investment to make. It's also preparation for integration. We want to learn the details of the business so that we're ready when we do close, that the transition happens as smooth as it possibly can.
Totally.
And a lot of that is learning during operational diligence how the business is currently run and how we're planning on running it in the future.
Absolutely. You want to set the foundation for success on integration. Deals can be won or lost on integration early on in the process. And then also too, the buyer is going to want to have a 3 to 5 year plan for what they want to do with the business. And this commercial diligence process helps inform what that could be.
And then we also do at that point, we're also doing financial diligence.
That's right. So financial diligence. This is going to be usually an outside advisor doing what's called a quality of earnings that basically just says, what are the financials of this business? What is the expected earnings base or run rate earnings base of the business based on what we've seen? And are there any adjustments to the financials historically that we need to make to sensitize the business for what it's going to operate like post-close? So for example, we see a lot of owners that will run personal expenses through the business prior to us investing, which we're not the IRS, so that happens all the time. It's a very normal thing. But post-close, given that there's going to be a new ownership structure, that's something that's not going to continue. So you need to make sure that you're adjusting for those types of things because they're not in the earnings base of the business going forward.
And we don't do a quality of earnings on every deal, right?
We don't. Usually you only do them for bigger deals. For smaller deals that are maybe a little bit less sophisticated, you might do what's called a cash proof, which is basically just proving the revenues and expenses to the business to the bank account. So can you tie the cash that came into the door, the cash that hit the bank account, versus can you tie the expenses that kind of left in the financials to what left the bank account, just to make sure that things are real. But each diligence process is going to look a little bit different depending on the sophistication of the business.
And even if we don't do a cash proof, there is some level of diligence that we do reviewing the financials and customer tickets and data like that.
Absolutely. As a buyer is always going to want to understand the financial framework that we're stepping into.
Okay, and then where does legal fit into this?
So there's kind of two work streams for the legal side. There's legal diligence. This is stuff like contract review, lawsuit review. Have there been previous owners of the business? What are the business filings and requirements and formation documents and that sort of thing consistent with our understanding of how the business has operated over time? Everything on the legal side, just to make sure that there's no issues that need to be resolved or brought up over the course of the deal. And lawyers from both sides will help facilitate that.
That includes licensing and permitting and all that
Absolutely.
too. At least in our industry.
All the compliance kind of related items are caught up in that legal work stream.
Okay, so we have a operational diligence work stream, we have a financial diligence work stream, we start the legal work stream. While that's going on, talk a little bit about the legal part of it, the documents that are involved in this part of the life cycle.
But before we go to legal, David, I might just tick a couple other ones that, depending on the deal size, you might go through. So there's stuff like tax diligence that somebody might think about. A lot of times there may be other commercial diligence items like environmental diligence or insurance diligence, health and benefits diligence, people diligence. So just all areas of the business that a buyer might want to get their arms wrapped around and make sure they understand exactly what they're stepping into is areas of diligence that they might kind of include in the process. But as far as the lawyers go, so while they're doing the legal diligence side, which is obviously a big portion, they're also going to be focused on drafting the documents that are going to memorialize the deal. And this usually boils down to a few major ones. Number one, the purchase agreement. That's the document that's going to inform the specific deal itself. Number two, depending on the structure, is going to be an LLC or partnership or corporate governance document that basically says how the business is going to operate going forward and who has what sort of governance or voting rights or board seats, or how particular provisions to buy or sell future shares of the business are handled. So that's the LLC agreement. And then the third major one is employment agreements for either the management team or the owner themselves.
There's one other part that sellers I probably need to know about, and this might be one of the hardest parts of the deal life cycle for a seller, and that's the schedules or disclosure schedules. Why are they such a pain?
Yeah. So first of all, the question is, what are disclosure schedules? And the answer is, in the purchase agreement, there is going to be a long list of things that representations that you as the seller are going to be making about the business. They could be as simple as, I own this business, or I have complied with the tax laws of this business, or I am in compliance with all the legal statutes I need to be in this business, to my trucks or my fixed assets are in working condition and there's no issues that I know about that I haven't told the buyer that would require future investment. And so there's a list of 15 to 20 items that you're going to be making those representations about, and supplementary schedules will support some of those representations. For example, it could be an employee listing, or a listing of the outstanding AR in a business, or the financials as of a point in time for the business. And so a lot of these items are things that the seller has not been looking at, or has not been thinking about, or has not been keeping in one place such that they're easy to find. And so it takes a while for them and the lawyers to compile it so the deal can move forward and memorialize everything at close.
Yeah, one of the things that we've found many times is sellers get very frustrated because a lot of the stuff that they have to produce in the disclosure schedules, a lot of it has already been produced in the diligence phase. Yeah. And so like they produce their P&L, their balance sheets, their vehicle list, their employee census, and we're just asking for it again, all over again at the end. And like, well, I already supplied that to you. And so, sometimes it just has to be refreshed. I think the difference is that in the in the purchase agreement, you're making a true representation, a legal representation that this is the status of your business.
Exactly.
Whereas in diligence, we're doing it more so we can learn more about the business. So although it is frustrating, and it can be frustrating, it's a necessary component of the deal process.
When you're making that final representation, everything needs to be right because it is a legally binding agreement that says this is the status of things as of this particular point in time that you are then signing your name for. Sure. And are going to be on the hook for potentially in the event that things are not that way. So you want to make sure that those are consistent with what's in the deal docs. It's consistent between the facts on the field and really the representations that you're making, and you want it to be right, even if it is frustrating.
Yeah, maybe you're on the line, you're signing it, and there are provisions that you're telling the truth. Yep. Okay, let's get to the fun part. So now all the documents are signed. We're at close. What does that look like?
It kind of depends on the buyer, but usually close is the fun part because that's when money is funded to the seller. So how close normally looks is the lawyers and the deal makers on either side will likely get on a phone call and effectively say, all the docs are done, everything's agreed, we're going to hold these documents in escrow and signatures in escrow pending funding of the deal. And then the buyer will wire money to the seller once the seller receives that money, the deal is closed and everybody celebrates. So it should usually be a fun time, and it's a win for everybody because of all the hard work that went into it. And that's one of the funnest days in this whole process.
One thing that we get asked a lot about from sellers is, where should we meet for the closing? I think there's this perception that we're still in the world of everybody meeting at a lawyer's office at a big conference table, and like a closing of a piece of real estate, we're passing around contracts and everybody's signing. That's just not the way it's done anymore.
Yeah. We live in the 21st century and DocuSign exists. So a lot of times this is done virtually.
Yeah.
I would say most times it's done virtually.
I think that's very surprising to a lot of sellers, because they still think it's that formal process in a conference room at a lawyer's office.
You can close from anywhere so long as you have the ability to sign and review documents and kind of get everybody aligned together.
That's great.
One other thing that a lot of folks like to do right at close or shortly after close is have a closing dinner, whether that's with the deal team or with the seller themselves. That's usually a fun part of the process as well. But closing is usually a little bit different than people expected on the front end.
No doubt. Just in summary, how long does this whole process generally take? I know it depends on the size of the deal, but generally, how long does this process take?
I would say most deal processes, if they're well coordinated, take somewhere between 60 and 90 days. They can be a lot faster for bigger deals where the infrastructure is ready to support moving more quickly. Documents are in order, the advisors have been engaged, people are ready to move quickly. But the timeliness is going to depend largely a lot of times on the seller and how fast they're ready to move. But sometimes it can be based on the buyer and their process.
And sometimes they take a lot longer. I mean, there are some, depending on the size of the deal, there are some legal things that have to be,
Totally.
Antitrust things that have to be taken care of and stuff. So it may take a
Absolutely.
little bit longer, but generally 60 to 90 days is probably a good timeline.
Yeah, there's antitrust, there's licensing requirements sometimes potentially that you need to think about. There's legal filings that you need to think about. So there are some compliance-driven timelines, but in general, 75 to 90 days is a fair timeline. And anything longer than that is there's usually something else going on, like the buyer can't raise the money, or there's issues that have been found during diligence that people need to figure out how to handle.
Okay, so we've gone through the deal life cycle. We've gotten to the close. It's a lot of fun. For sellers, this is the end of the road, at least as far as the deal process is concerned. It's an exciting time. It's a time to celebrate. You put in a lot of hard work to get to this point, and congratulations, the deal's been closed.
If I could leave with one piece of advice or a couple pieces of advice for potential sellers, do not try and save money on using your mom's hairdresser's friend's attorney that does probate law for their career. Find talented, competent advisors that have experience in M&A transactions, and that's going to be helpful to protect you. It'll move the process along more quickly, and ultimately it'll increase the certainty to close because people know what they're doing. Yes, those people cost a little bit more money, but you're ultimately going to end up with way more favorable in market terms and something that's much more reasonable and timely.
I think the same thing probably applies for financial advisors too.
Absolutely.
I mean, there's different. We'll at a different time we'll talk about different deal structures and tax implications of those. But having a good financial advisor is probably pretty important as well.
Financial advisor, CPA, all the deal advisors that are involved in the process should have a lot of experience doing what we're doing. It just helps facilitate things much more quickly.
Great advice.
Poor decisions. One beer, one bad deal decision, and one lesson we paid for so you don't have to.
All right, so we're now part of our poor decision segment on talking about deal life cycle. Today we have a beer called Lagunitas IPA, the legendary India Pale Ale from Petaluma, California. So let's get into this one.
Do you know what an IPA is, David?
I have no idea. India Pale Ale.
India Pale Ale, so they put more hops in the beer, make it higher alcohol content. So when the ships were sailing to India, the beer would not go bad.
Look at you. A little history buff along with it.
That's right.
All right. Cheers.
Cheers.
Enjoy. All right.
I'm just happy to see that you've learned how to pour beer over time.
It's taken a few episodes. All right, so let's talk about a poor decision that we had witnessed specifically related to deal life cycle and what a potential seller might be able to learn from it.
Yeah. So we're back to Shaun's poor decisions. Early on in my deal-making career, we were very excited about a particular transaction. And the seller had been on the fence about doing the deal and still kind of wasn't sure that they wanted to move forward. And so we agreed to have a limited exclusivity period in the LOI. And when I say limited, it was, I think it was 3 weeks or so. But we had planned on getting a bunch of the diligence done during that time period and being ready to close in relatively short order. However, once we signed the LOI, the seller effectively just stopped providing us with information, and we were not as responsive as we should be in making sure that the ball was getting pushed forward to get all the diligence done. And ultimately, the exclusivity expired. The buyer had used that time period just to learn about the process and or what our expectations and asks were going to be for the deal, and used it to go shop the deal to another buyer, which he then sold the business to after our exclusivity had expired.
So you lost the deal.
Lost the deal. We did not get that one done. He sell-yad to somebody else.
That's a shame. And from that, what would be the lesson learned for, let's say, a seller? I think it would relate to probably communication and keep a strong cadence of what's going on in the deal life cycle.
The most important thing I learned in that experience was to make sure that you set expectations specifically around timeline and what needs to happen when very clearly on the front end, so that everybody knows who's doing what, how, when, and there's total alignment in the things that need to happen over the course of the diligence process, because there's going to be a lot of balls in the air. There's going to be a lot of advisors that are doing different things, and making sure that you have very clear deadlines and thresholds that need to be met at certain points in time is important.
Okay. Another poor decision.
Another poor decision.
Hopefully somebody will learn from it.
All right. So yeah. If you're interested in learning more about the potential sale of your HVAC, plumbing, or electrical business, or have general questions about the process, feel free to contact me at Shaun@redwoodservices.com or contact us at redwoodservices.com.